A major milestone for the Dow, closing above 28,000 for the first time. New records, too, for the S&P and Nasdaq. Big-name stocks like United Technologies, Alphabet, Microsoft, all hitting record levels. So is this market just headed higher and higher, Guy?
That's a miserable song, isn't it?
I don't
Tim,
think the music.
You know what? There was a time and a place for it, but not. This is not the time and the place to talk about it. So let's talk about the market.
Well, kudos to everybody on the desk, but me, that have thought this market's going to continue to grind higher. I mean, there's so many headwinds, there's so many things to be concerned about, and we've rattled them off. The market doesn't seem to care. The VIX closes at 12, which in my estimation is way too low in this environment, but the S&P continues to grind higher on a day where the only real news is the president and part of his administration talks about getting closer and closer to a trade deal with China that I thought we had phase one signed a couple of weeks ago. They're getting a lot of mileage out of that. Earnings have been good, but again, I do think this market is not nearly looking at all the negatives closely enough. And at a certain point, they're going to matter. I just don't know what the exogenous event is.
A lot of people felt the way Guy did, and that's the reason why we keep marching higher, because positioning was so negative. So now you only have 2 months left to gain where you want to be in the market. That's why it's going to go higher, in my opinion.
And S&P, that, by the way, is up 25% this year. I mean, this was, this is one of the quietest, great years of all time. And if you think about it, also, we're kind of coming out of this period of this negative rate, spiral. And so the normalization process, to me, also, I think, is a big part of some of the health of the market. But I know Jeff's got some views on technically and tactically. I'll let him talk about that, because I do think you can get to a place where the positioning Steve's talking about, the sentiment of pain, which was higher for the market. Sorry about the song, Guy, is something that I think we've started to normalize a bit. But the things that you should be very comfortable about, I think, for an investor are we've gotten decent guidance. We've had a dynamic where the dollar has settled into a range. There's a lot of folks calling for a slightly weaker dollar. I see not only rates normalizing, but and that's not a bad thing. That's good for equities. But I see basing in industrial commodities. I see global markets that have a very good glide path into next year, even if we may be getting a little zany right here. And then Google, Apple, and Microsoft, they make up 30% of the triple Qs. I mean, think about those charts. All three of those charts, again, maybe a little overbought. But if you're looking for what takes the market higher, these three names are cruising, and I think that's good news.
And look, we're long-term investors, right? So we don't see a recession next year. So when that's the case, we're going to be fully invested most of the time. The economy still looks okay. The yield curve is re-steepened. Employment's good. So for all of those reasons, I think the market rises over the next 6 months or so. And then you have some of the major headwinds, trade, central banks, global growth, all looking a little bit better. And for better or for worse, probably for worse over the long term, you have the liquidity backdrop. It is what it is, right? M2 money supply growth is now growing double the pace of GDP, so money needs to find a home. But to Tim's point, tactically, I think if you want to look for a little bit of a pause or a pullback here, you could get one. The S&P is technically overbought. You have over a quarter of the index trading at 2 standard deviations above their 65-day moving average. Some of the sentiment indicators that I've been pounding the table on the show over the past couple of months, slowly starting to move the other way. And I do think that leadership has been really interesting this month. So the market grinded higher, but what led the way? It was tech, it was healthcare, it was real estate, and it was utilities. Energy, financials, and consumer discretionary were the laggards. So maybe under the surface, there's this need for a little bit of a pause or pullback.
Right, but if you think about it, you can unwind an RSI that's overbought in the S&P. It doesn't mean that you have to sell it off. You just have to unwind it naturally. And I think the biggest out of all these conditions is the Fed. The backdrop of the Fed is off the table now. He is a dove and will remain positive on the markets.
I also think that the backdrop of everybody calling for a recession, it was just a countdown. When are we going to get it? We have 12 to 18 months before, this and this and that. We're not getting a recession anytime in the near term. And yet we even got some data this week. We got some data today from the New York Fed and from the Atlanta Fed, which were a little bit more hawkish in terms of the fourth quarter, 0.2, 0.4. But if you look at the prospects for 2020, if you look at the job market where it is right now, it's very difficult for me to see where we technically, at least, and by definition, get to a recession.
I don't know if I'm willing to make that bet that we're not getting a recession. I'm willing to make the bet that
we'll get a recession, but we were calling for it in the people were calling for it. They had their eye on it. They were looking at global data, and they were saying we're getting it. It's just a matter of when.
When the Fed says it's not so much that he's not cutting rates anymore. It's that the barometer or the benchmark for him to raise rates
Very
is
high.
incredibly high. So that pushes everyone into the most risky of assets, and that's the market.
It's interesting, though. I mean, GDP started the year, north of 3%. We're probably going to come in half of that in the next. I mean, so things are moving, in my opinion, the wrong way. But Steve's right, and Jeff is right. I mean, you have this money supply. Say what you want. I mean, this is QE by the Fed. I mean, they can say it's not. It clearly is. Balance sheets. It's clearly what's going on.
They denied it up there.
Well, balance sheet's going to continue to grow. I mean, they stopped raising rates, obviously. I mean, this is quantitative easing. And this overnight repo thing that we don't talk about it at a certain point is a big deal. With that said, I mean, who am I to argue with this? The one interesting thing today is Walmart, which reported, I think valuation finally mattered with Walmart in this quarter. It wasn't a disastrous quarter, but I think people woke up and said, wait a second, Walmart shouldn't be trading at 24 times next year's numbers. At a certain point, they'll probably say the same thing about Microsoft at 27 times next year's numbers. I mean, valuation will matter. People are just not focused on it.
What's interesting is on Walmart specifically, they haven't grown EBITDA. It's all been multiple expansion in Walmart, because when you start to grow that digital or e-commerce, it actually costs them more than someone driving up to the store, picking it up.
The product mix is not beneficial on e-commerce.
Product mix is not beneficial.
When it's mostly grocery,
right?
Well,
it's razor-thin margin.
It's funny because you saw that in the retail sales number that came out today. On the headline, the retail sales number was okay, but when you stripped out autos and gasoline, it was actually a weaker number. Walmart, Target, big box, they had their place, I think, in a market where we were questioning about recession, and it was a safer play. The fact that they printed this is yesterday's news, but I mean, they printed 3.2% on same-store sales, which I think for Walmart is actually quite good.
Well, let's talk about positioning for a second, right, and getting back to economic fundamentals. I do think that there's evidence that the global manufacturing cycle is actually bottoming. I think you see more evidence of PMIs here, PMIs globally turning up in the first quarter of 2020. So what do you want to do in that environment? I think that's when you see the more durable rotation into cyclicals. And if you're going to see cyclicals do better, guess what? You're probably going to see international stocks do better. If you look at the MSCI ACWI ex-US versus the S&P 500, way more tilted towards cyclicals than the S&P. So if you like value, if you like cyclicals, pay attention to international, because our clients, when I speak to them, they're very underinvested in internationals because they just haven't worked recently.
Okay, so contrast what Jeff is saying, Guy. Your view of the market is a little bit more dour and
100%,
pessimistic.
but it's been wrong as well.
Right. So invest in the market or trade the market you have right now.
100%.
It would not be industrials,
No,
I would guess.
I don't think it's necessarily industrials. I mean, healthcare, I think, is starting to pick up steam again. We've talked about that for quite some time. And you see what happened with the hospitals, names like UNH today on the back of some of the comments from the president. But this started prior to that as well. So I think healthcare still works. I mean, energy seems to have found a bottom in the short term. I think there's some value there as well. Industrials sort of scare me. I understand what Jeff is saying. Maybe things have bottomed, and maybe that's the best time to get a lot of these names. But, I'm not ready to call a bottom yet in a lot of these industrial names.
I'm going with the cyclical play because I do have exposure elsewhere to tech, but I'm going as the cyclical basis has not panned out so far. But WestRock is one of my names. Olin Corp, one of my names. I'm hoping that it lasts longer than 2 or 3 days at a clip.
But to Guy's point, too, I worry about the cyclical trade from now through the end of the year, because I do think, as crazy as it seems, I think we're still digesting tighter financial conditions a little bit. So you could see
these are trough valuations in the cyclical.
Agreed. But I think you could still see lower PMI prints. Typically, when PMIs continue to push lower, then you see industrial cyclicals not do well.
Already priced in.
But yeah, potentially. But we would be slow to move into value. I like value, but I would wait till Q1 because I think that's when you'll see the durable bottom. And I think that's going to last for a while. So I think being a little bit late to the game, at least for our clients, probably isn't the worst thing in the world.
I think having a barbell approach, which means owning something here and maybe being either short something in the middle, but that's trader speak for. I think owning semiconductors and ultra-cyclical stuff, not only has it worked, but I think it's going to continue to work. I look at a FedEx that is a trough multiple, has been struggling, and the chart guys, I think, should be telling you, you've built the base, this thing is actually starting to challenge to the upside. That's the kind of a stock to me that moves into next year, especially if we've seen this bottom on PMIs. And I don't think anyone here is saying bottom on PMIs means off to the races. It means you're stabilizing. And that, essentially, that degree of change is that much more impressive when things go from awful to just bad. That's when you get the biggest moves.